Every weekday, institutional investors move trillions of dollars through financial instruments that most Americans have never heard of. Not exotic instruments, standard tools of Wall Street's largest players, but structured, priced, and distributed in ways that make them effectively inaccessible to the public. Today we document 5 of them, verified through SEC filings, Federal Reserve data, and academic research. Every instrument in this video is real, currently active, and fully sourced. We name the exact legal mechanisms and documented evidence. Instrument 1. OTC derivatives via ISDA master agreements. Large banks and institutional investors hedge risk through privately negotiated over-the-counter derivatives, governed by the International Swaps and Derivatives Association. According to the Bank for International Settlements, OTC derivatives outstanding reached $667 trillion in the second half of 2023. These contracts are negotiated privately between institutions, away from any public marketplace. Minimum transaction sizes start at $1 million. Retail investors have no direct access. Instrument 2. Primary dealer repo agreements with the Federal Reserve. The Fed operates through 25 primary dealers, Goldman Sachs, JP Morgan, Bank of America, Citigroup among them. These dealers participate in repurchase agreements where the Fed buys securities and agrees to sell them back, injecting or withdrawing liquidity daily. Access is restricted exclusively to primary dealers. According to New York Fed 2023 data, daily volumes routinely exceed $1 trillion. Instrument 3. Regulation D private placements. Under SEC Regulation D, companies raise capital without public registration. According to the SEC's 2023 Regulation D report, Reg D offerings raised $4.45 trillion in 2022, compared to $1.2 trillion through public IPOs. Private placements raised over 3 times the entire public market, almost entirely invisible to retail investors. Access requires net worth above $1 million or annual income above $200,000. Instrument 4. Structured notes from private banking desks. JP Morgan, Goldman Sachs, and Morgan Stanley issue structured notes, custom debt instruments linked to stock indices, commodities, or interest rates, engineered to provide downside protection with market upside. According to the Structured Products Association, U.S. issuance reached $110 billion in 2023. These are sold exclusively through private banking relationships serving clients with at least $250,000 in investable assets, not listed on any exchange. Instrument 5. Private equity co-investment rights. When Blackstone, KKR, or Apollo raise a fund, their largest institutional partners, pension funds, sovereign wealth funds, endowments, negotiate co-investment rights to deploy additional capital directly alongside the fund at zero management fees. According to Preqin's 2023 survey, 76% of limited partners actively pursued co-investments. Minimum fund entry, $5 to $25 million. Legally restricted under the Investment Company Act of 1940 to qualified purchasers with at least $5 million in investments, 5 instruments, $667 trillion in OTC derivatives, $1 trillion daily in Fed repos, $4.45 trillion in private placements annually, $110 billion in structured notes, co-investment rights for billion-dollar institutions only. The public market is the retail window. The real financial system operates in a parallel structure, different rules, different returns, different access. Subscribe to Hidden Wealth Files. Next video. 5 financial crises predicted in writing before they happened. And who profited.